This is our Forex blog for April 10th, 2012, and like we do most days, we buy the strongest currencies versus the weak and sell the weakest versus the strong. There's about 15 different systems that we teach in our classes. However, one of the easiest ways for both experienced and new traders alike to trade the best is to use this currency meter. The top histogram is the real-time momentum. It's made of comparing the dollar to every other pair, and it uses 5 of our best statistical trend tools. We average those together into one easy-to-read indicator. Most people can't process more than maybe 2 or 3 pieces of information at once, certainly not 5. 3 of them measure the direction, and 2 of them measure the intensity of the direction. So anytime you have red and it's at or above the dotted 80 level, it's extreme, and that's a trend that's very likely to continue, especially if it matches the daily trend, which is underneath that, and underneath that's a weekly, and underneath that's a monthly. So a couple hours before midnight, you had a weak dollar. The daily trend shifted down. It just started getting really intense. The weekly trend was just slightly up, and the monthly trend was pretty strong. I pretty much ignore the monthly trend. It doesn't have that much impact intraday. Swing traders might find it useful. But if you find some weakness here, you want to sell the dollar versus whatever the strongest pair is. Let me scroll this back to started right at midnight. We'll see which pairs were strong at that point. Coming up to midnight, the pound was relatively strong, and also the New Zealand was. So right before midnight, you want to buy the New Zealand dollar. You can see this one was above the, came from underneath above the hourly, and it went from around 10 all the way up to the previous day's high at 38 here. And I always use our range charts. I'm going to scroll this up here so you can see it. This has intelligent trailing stop on there. You could have went long right here at 06 and then use this to get out at 24. So you made about 18 pips. And usually if it comes up to a resistance area, previous day's high, and it kind of runs out of steam, you can see that's exactly what happened here. You might want to exit half your trade and then use a trailing stop to get out of the second half. Sometimes if volatility expands, we tighten or widen the stop. That's what happened here. Typically what I do is if it goes up and goes sideways for a couple bars, I'm out, and then I'm going to get out of the stop right here. I don't believe in waiting for it to trigger the opposite direction. I'd be out of the second half here at 29, the first half at 37. The average exit would have been about 33, and I would have waited for it to go above the hourly right here. We do have the monthly pivot level right here. You might actually even wait for it to break through that resistance area first, in at 14, and the average exit's around 34 for a nice 20 pip win. Now later in the day, the dollar started showing signs of strength. One way of knowing when a trend's going to continue is when you have incredible strength like this, and then the pullback phase has very little weakness. If the daily, weekly, monthly trend are all up, it's pretty much a no-brainer to look to buy that currency. Coming up to 2 o'clock right here, we have the yen that's very strong. Let's see what we have. The Australian is pretty much down on all time frames, and so is the Swiss. The euro, the weekly monthly trend's down. It also had incredible, let's scroll it back so we can see exactly what it looked like at the time. It's a lot easier to compare. Alright, the euro is the weakest one right there. The daily trend is still up in there, but you can see right here it started shifting to, or at least gave one indication where it went down. So that usually can continue. And here, right around 2, the euro comes back to being weak. So the two, probably the highest odds trades at the time, or there's 3. Selling the Australian yen, the Swiss yen, and the euro yen. So we'll start with the euro yen. Here's our range chart. This is 6 pips per bar, and you can see it started off the day above the hourly moving average, and that's usually a sign of bullishness. However, you can see it broke out from above or below to above the previous day's high. Once it comes back into the previous day's range, in other words, underneath yesterday's high and greater than yesterday's low, it really can go either direction. A lot of times it will pull all the way back to the hourly right here, find some support, and then go up. But in this case, the real-time trend shifted down, the intermediate time frame trend was down, the daily trend was still up, but that shifted down a little bit earlier today. You would have been looking for sells, and especially if you use our currency meter, you might have just got in this trade right here around 107.10, And using the range chart's intelligent trailing stop, you can see you made about 35 pips there. On a range chart, usually after a 3 to 5 bar up move, when you get one red bar like that, you can usually sell it when it goes 1 pip underneath there, and you can put your stop 1 or 2 pips above the high, and anticipating, a move down. And that way, instead of waiting for another 3 pips to hit the trailing stop, you're short. As it goes down right here, you can see the weakness kind of falls off. We are at the previous week's low. That is a major support area, and usually, it found support there before. It's found support there yesterday, today as well. You can always move your stop down to break even, or even above this level right here. And then it kind of went sideways. You might have went short right here, pretty much break even, short again here. And at that point, you want to draw your fibs on the first wave down. The fib targets are excellent. The bigger the fib, or the swing, the more likely the fib targets are. Here's the 1.382 fib target. The previous day's low. We're underneath the lower containment band, so it usually reverses underneath there. You would have been short the second one right here at 48 and out when it hit the trailing stop at 08. But that's a 40 pip win. And more than enough to get rid of 5 or 6 small 5 to 6 pip losses and also leave you some profit left over. Once the market's gone down a lot, usually you're going to wait for a little bit more of an up move. In other words, I wouldn't have gone short right here. I'll wait for this, short right here, small loss, short right here. And in fact, this is another 1, 2, 3 reversal. You might have gone short right here and then lost a few pips, and then short right here at 36, and it came back down to the lows and had less weakness than before. Usually when it's underneath the lower containment band, if you get a double bottom like that with visually half the weakness you had before, it's going to run out of steam there, so you're out. The second trade you would have been short at 38, maybe out somewhere here, let's just say 18. You made 20 pips. So if you lost 8 pips and then you made 20, you made 12 pips on these 2 last trades, plus 40 on the previous one. And obviously there were some nice trades earlier as well. And that's the whole key to trading. Small losses, big win. Remember, the Australian was also another one that we would be looking for sells in. Australian yen. Let's bring up the range chart because this has smaller losses than other time frames. And you can see the same thing. This one started off the day above the hourly, and it did find support here. Notice the 3 bars up, 1 bar red. You sell it 1 bar underneath there. It usually lets you get into trades. If you really are expecting it to fall, which it's blood red right here, it really should go lower. You can get into a trade here at 14 versus 10 or 9. That's another 4 or 5 pips profit. And then when it comes down and lets you out right here at 88, you made 16 or so pips. And let's just say you shorted here, lost 8 pips, shorted here, lost 8 pips. You short again, you made 5 or 6 pips, short again here, it fell about 20 pips. And usually when it gets underneath the lower band, you tend to get reversals. One other thing that causes reversals is our 3.0 containment band. This is a great way for people who want to do counter trend trading. Once it goes underneath our 3.0 band, which I like to color green, typically you're going to get a big reversal. And so you can usually wait for 1 bar of green and buy, which will be right here. And as it starts to go up, if you got out with this trailing stop right here at 22, you're in at 15, you made 7 pips. It didn't really reverse that much. You buy it again right here at 29, and you're out at 70. Huge 40 pip counter trend move. And like I frequently say, usually when currencies are down way too much, they're going to retrace back really near to the hourly moving average. Or another thing that they do is they typically retrace 50% of the whole move down. That's an excellent profit target. So 1.5868 is your profit target. If you got into this one trade with a few pip profit, bought again right here at 31, your profit target's all the way up here at 68. It's a 37 pip profit target while risking less than 10 pips, because remember, you're risking 6 pips, which is the 6 pips per bar chart, plus 1 or 2 pips padding plus the spread. So your stop is usually 10 pips or less, and usually you only get in when it starts moving your way. So usually that momentum causes it to go up 5 to 10 pips, which moves your stop to break even, and that's just a high probability way of trading.